What exactly is standard costing? Standard costing is when an organization substitutes an expected cost for the actual cost in the accounting records. For example, if the standard cost for a kilogram of sugar is expected to be $1.25, the organization will use this estimate as the standard in all of their costing in their accounting records, even if the actual cost per kilogram is $1.32. Or, if a standard hourly rate for employees is $18 per hour, even though the actual cost is $17.50. Why would a company do this? Because standard costs, when they're developed carefully, have some compelling advantages. Organizations gain better control over costs when they set a standard. The standard can be compared to the actual to highlight variances. This can be used as a basis for evaluating management's ability to control costs. If standards are developed realistically and carefully, then actual costs will be close to the standard costs. Because of this, management can use standard costs to develop accurate budgets, aiding management in planning for the future. Also, if standard costs are well developed and close to the actual costs, they can be used to set the prices of goods or services. Standard costing simplifies the process of valuing inventory. Actual costs for inventory items can vary widely due to things such as machinery breakdowns or inexperienced labor. Standard costs ignore these unusual cost fluctuations. It allows management to recognize that when they produce identical products, they should be recorded at the same cost, which is what standard costing does. The benefits of a standard costing system have therefore resulted in its adoption in not only manufacturing, but also in service and not-for-profit organizations. What is the difference between standard costing and budgets? Both standard costing and budgets use estimated costs. Both standard costing and budgets are used to support management's function of planning and control. The difference is that standard costs are a measure of one unit. For example, 1 hour of direct labor at the rate of $18, or 1 kilogram of raw materials at the cost of $9 per kilogram. Budgets are used to refer to total costs, such as the total direct labor budgeted as $378,000 or the total direct materials budgeted at $900,000. In addition, standard costs are used when making entries into the accounting system, but budgeting costs are never used. How are standard costs developed? Standard costs are developed for each manufacturing cost: direct materials, direct labor, and manufacturing overhead. To develop direct material standards, management will consult the purchasing division, product managers, and production supervisors. Often, the current purchase price is used, plus an estimate of the quantity of direct materials required for each product. To develop direct labor standards, the payroll department and the production supervisors are consulted to determine pay rates and the hours required to produce a product. And in order to develop manufacturing overhead standards, both variable and fixed, management will look at historical cost information and ensure that they understand how costs change with the changing level of activity. This allows management to develop an application rate based on budgeted overhead costs and the budgeted cost driver or activity base. For example, assume Kira Inc. manufactures blankets for use by airlines. Blankets are embroidered with the name and logo of the airline. For direct materials, management has determined that each blanket requires 3 meters of fabric. This includes additional allowances for wastage and spoilage. The price per meter is $7, based on the cost of the fabric, less any discounts they receive from their supplier, plus freight costs and handling costs. For direct labor, management has determined that each blanket requires 4 hours of direct labor. This estimate includes not only the estimated production time, but also setup time and downtime when a machine might be out of service. The standard wage rate per hour is $18.50. This rate includes employee benefits and payroll taxes. For variable manufacturing overhead, management determines that the total budgeted variable manufacturing overhead is expected to be $256,000. Management uses direct labor hours as their cost driver, their activity base. They estimate that a total of 32,000 direct labor hours will be used during the period. To calculate the application rate, they divide the total budgeted variable manufacturing overhead by the budgeted activity base. So 256,000 divided by 32,000 direct labor hours is equal to an application rate of $8 per direct labor hour. This is the standard predetermined variable overhead rate. Kieso will do the same for the fixed manufacturing overhead. Management determines that the total budgeted fixed manufacturing overhead is expected to be $384,000. Management uses direct labor hours as their cost driver, their activity base. They estimate that a total of 32,000 direct labor hours will be worked during the period. To calculate the application rate, they divide the total budgeted fixed manufacturing overhead by the budgeted activity base. So 384,000 divided by 32,000 direct labor hours is equal to an application rate of $12 per direct labor hour. This is the standard predetermined fixed manufacturing overhead rate. We now have all the standards for Kieso Inc. How will these standards be used? Well, we can now determine the total standard cost per unit, which is the sum of the standard costs for the direct materials, direct labor, variable overhead, and the fixed overhead. We'll use a chart with the headings Description, Standard Quantity, Standard Price, and Standard Cost. We'll start by adding the direct materials from our example. Direct materials with a standard quantity of 3 meters and a standard price per meter of $7 has a total standard cost per unit of $21. We'll now add the direct labor from our example. Direct labor with a standard quantity of 4 direct labor hours and a standard rate per hour of $18.50 has a total standard cost per unit of $74. Moving on to the variable manufacturing overhead. Variable overhead is 4 hours. That's because we use the same number of hours as we used for the direct labor. Direct labor hours, remember, is our activity base. If we take the 4 hours and multiply it by the standard application rate of $8 per direct labor hour, it's equal to $32 per unit. Last, we have the fixed manufacturing overhead. Fixed overhead standard quantity is 4 hours. Again, that's because we use direct labor hours as our activity base. Take the 4 hours and multiply it by the standard application rate of $12 per hour. That's equal to the total standard cost per unit for the fixed overhead of $48. Total standard cost per unit is therefore $21 plus $74 plus $32 plus $48 for a total standard cost per unit of $175. This is the total standard cost per unit for this product. We can now use this as a basis for calculating the variances, the difference between the standards we developed and the actual results. Thanks so much for watching.